Your savings account is essentially a melting ice cube. From early childhood, we are handed a very specific set of financial instructions. We are taught to place our pennies in a jar, to accumulate uninvested cash, and treat saving as the ultimate marker of adult responsibility. This model functioned in an era where interest rates significantly outpaced the expansion of the money supply. Today, the yield on stationary cash is consistently lower than the rate of currency debasement. In the current economic environment, static capital loses purchasing power every year it remains uninvested. To navigate this, we have to redefine how we view fiat currency. A dollar is a transient medium of exchange, a tool for executing transactions, rather than a reliable vessel for storing long-term value. We are going to deconstruct the mechanics of this shift. The first barrier to accumulating capital is not a lack of discipline. The primary obstacle is biological stress induced by scarcity. Researchers at Princeton and Harvard analyzed a concept known as cognitive load to understand how financial pressure alters human brain function. They identified a state often triggered by operating without a basic emergency liquidity cushion. When an individual is forced to manage scarce resources, like an unexpected $1,585 car repair, the brain enters a state of constant short-term calculation. Because the brain is deploying all its resources to resolve immediate survival threats, it physically restricts the prefrontal cortex, the region responsible for long-term strategic planning. This chart visualizes the quantitative outcome of that restricted state. Financial scarcity causes a measurable 14-point drop in IQ. That is a cognitive decline equivalent to losing a full night of sleep or being mildly intoxicated. When executive function is impaired by this stress, complex decision-making becomes difficult. It is challenging to map out an investment portfolio when your biology is trapped in a 24-hour survival loop. The research suggests that by establishing a predictable liquidity cushion, the brain is freed from immediate survival calculations, which allows for the re-engagement of long-term strategic thinking. For those who have established that initial cushion, the standard target for long-term wealth, the traditional retirement model, is facing new challenges. For decades, the gold standard has been the Trinity study, which established the 4% safe withdrawal rate. The premise is that you withdraw 4% of your portfolio annually, adjust for inflation, and remain solvent for 30 years. This line graph projects a theoretical portfolio following the 4% rule, mapping a smooth 30-year descent. But if we factor in severe early market volatility, sequence of returns risk, these downward spikes destroy the compounding base, creating an unrecoverable deficit. The second challenge is rising essential costs. While headline inflation appears stable, non-discretionary costs like healthcare and property taxes compound at 15 to 20%. Withdrawing capital from a stagnating asset base while absorbing high non-discretionary costs creates a high probability of outliving your capital. To address these rising costs, we must look at the macroeconomic drivers. Many point to retail savings accounts offering a 4.2% yield as a safe option for capital. However, when a central entity expands sovereign debt, it dilutes the purchasing power of the existing money supply. This debasement outpaces interest on retail deposits. Keeping significant excess liquidity in a retail bank allows institutions to use that depositor liquidity to acquire the hard assets that outpace the rate of inflation. Static cash experiences a slow decay in value relative to real-world assets. The purchasing power of that capital is eroding while it remains unpositioned. Managing this requires a strategy of interest rate arbitrage.
This visualization shows the priority. The massive red pipe is a 28% credit card liability. It completely overwhelms the slow drip of a 4.2% interest return. Eliminating high-interest consumer debt is the most effective way to protect your capital's growth potential. Once high-interest liabilities are addressed, the next step is relocating your short-term emergency buffer out of the retail banking system. A money market fund housed within a brokerage allows you to capture yields that are closer to the institutional wholesale rate, removing the margin typically captured by local banks. Holding excess retail cash essentially results in a transfer of purchasing power from the depositor to the institution. Once the buffer is secured, the final transition is systematically converting surplus currency into assets with fixed supply. Hard assets are defined by their structural immunity to supply expansion. These are resources that cannot be created at will by central policy. This chart outlines the allocation. The first slice represents industrial and multifamily real estate. Fractional platforms now allow for the acquisition of these positions without a massive capital requirement. The second allocation hedges against escalating sovereign debt through digital scarcity. A 1 to 3% allocation into decentralized ledgers is becoming part of the modern framework for capital preservation. The third allocation targets the physical infrastructure of the digital economy. Positioning capital in energy production and physical transmission offers long-term leverage as power demands increase. Executing this strategy consistently requires moving beyond manual decision-making and using algorithmic automation. Setting your accounts to automatically route capital from your earnings directly into these brokerage positions bypasses the decision fatigue and biological stressors we examined earlier. Sustained capital growth is achieved not through willpower, but by engineering an automated pipeline that continuously converts currency into scarce infrastructure. We have traced the shift from the biological stress of a saver to the strategic positioning of an investor focused on structural assets. Stagnation is often the result of following a financial map that was designed for a different era of monetary policy. The logic is clear. Reduce high-interest liabilities, capture wholesale yield on your buffer, and algorithmically automate the acquisition of fixed supply assets. Recognizing that the perceived safety of cash is temporary is the first step towards building a financial architecture that preserves purchasing power regardless of policy shifts.